Okay, welcome, ladies and gentlemen, boys and girls, to part 4 of the Daily Trading Coach 101 Lessons for Becoming Your Own Trading Psychologist by Brett N. Steenbarger. If you guys have watched the previous 3 videos, you pretty much know how this works. So let's go ahead and jump right into it here. So this video is going to focus on the coaching process, steps towards self-improvement. And the quote for this chapter is, "Success does not consist in never making mistakes, but in never making the same mistake twice, or the same mistake a second time." And so this chapter is going to kind of go through the different portions to the coaching process and a couple different examples and a couple different aspects of the process and how some of those fit together, which ones work best for you, and which ones you'll find the most success with. So without further ado, let's go ahead and start self-monitoring by keeping a trading journal. Self-monitoring is the foundation of coaching because it tells us what we need to change in ourselves. We can't alter a pattern if we don't know that it exists. And so the most common way to monitor yourself is through a trading journal. Now, depending on the trader, some traders will journal periodically throughout the day, depending on the kind of trader they are. And then some will just make one entry at the end of the day after they've finished trading completely. But the key to the journal is to record your patterns when they occur and they're still fresh in your mind rather than relying on fallible memory. So just make sure that however you are deciding to do a trading journal, make sure that you're not putting it off. I'm gonna do this after the weekend, or I'm gonna do this next week. You want to make sure that you are doing your trading journal when everything is still fresh in your mind, when you can remember specifics, when you can remember price, when you can remember specific factors that influence your trading. That's when it's important. So self-monitoring in itself is not a change technique, but it often leads to change. So systematic review of your performance over time makes you more conscious of what you're doing and can help you continue to recreate good habits and avoid bad habits. I mean, obviously this stuff kind of seems like common sense, but the more you pay attention to what you're doing, the more aware you are of your habits, the easier it's going to be to review them and then change them. So the best predictor of failure in the markets is the inability to self-monitor. So if you cannot keep a trading journal, if you cannot keep tabs on what you're doing and what you're thinking, then the chances of you being successful in the market are going to be very low. And this can leave, without a trading journal, this can leave traders unable to clearly identify their patterns and reflect and learn from their efforts at change. Because you got to remember that goals without self-monitoring are just intentions. They never translate into concrete actions to initiate and sustain change. So you can want to do all kinds of stuff. You can have all kinds of goals. But if you are not watching to see what you're going to do to actually make steps to change them, then those are just intentions and they're pretty much empty. So the goal here is not for you to just have a bunch of thoughts, but to translate those thoughts into actions to make yourself a better trader. So why does a trader who's desiring success fail to sustain efforts to monitor their thoughts, emotions, and trading performance? Well, too many traders are motivated by trading and making money. And what they need to do is they need to be more motivated by understanding themselves and the markets. Again, this goes back to what we were talking about in the last video about being a better trader and figuring out that market puzzle. It's not about just making money and getting out. It's not about being the barfly trader, right? The barfly traders are motivated to win, but not motivated to do the actual work it takes to become a winner or a consistent winner. Because barfly traders, you'll hear them. Those are the guys that tell you, "Oh yeah, I made $50,000 on one trade," and yeah, well, you also lost $50,000 the 3 trades before that. So you need to make sure that you are motivated to do the work to be a consistent winner. And we see this trend that in the best traders, self-mastery is the core motivation, not making money. The best traders want to be the best that they can be, and the money comes afterwards. So here's an example that we're going to go through of one way to set up a trading journal if you're not sure how to go about it, but you want to start monitoring yourself. So what you want to do is go get a notebook or something, and then for each day you're going to want to make 3 columns. So in column 1, you're going to describe the trade that you placed. You're going to summarize what you did for each trade idea. You're going to summarize how much you risked, and then why did you risk that much? How much money did you put in? And then what price you paid for that position, whether it was a market or limit order, what did the spread look like if you did a market order, how far away from price did you get filled, that type of thing. And then how did you place the trade? Did you place all your shares all at once? Did you place all your contracts all at once, or did you scale in? Okay. Then column 2, you're going to summarize just the broad outcome of the trade, and then the price and times of your exits. So, column 1 is going to say what you paid and when you got in. Column 2 is going to say whether or not you made money on that trade or lost money on that trade, and then how long you held the trade for, and then what you got out at. And then your column number 3 is going to be your behavioral observations. So these are the things like, what were you thinking? What were you feeling? How confident were you in the trade? And what you want to do is you want to analyze yourself and your state of mind, your thought patterns, and your physical state during the trade. Were you uncomfortable? Were you panicking? Did you need to stand up because you couldn't sit down in your chair, because the nerves were getting to you, that type of thing. So you want to make sure that you are keeping tabs on that aspect of your trading as well, so that way you encompass the entire picture. So it's not just about the numbers on the screen, it's about how you're perceiving them and how you are reacting in that environment. So here's a big thing. Whatever you do, keep your trading journal simple and doable. Most traders stop keeping a journal because it becomes too complicated and too onerous. If you have to sit down every night and write yourself a novel, the chances that you're going to want to sit down and do that every single day are very low. So whatever you decide to do for your trading journal, make sure that it's simple and that it's not too complicated and that you can do it over and over and over again, because you're going to want to be doing it every single day. Just as an example for myself, I make trading videos. So obviously this software that I have allows me, as you can clearly see, to make voiceover videos. So what I'll do at the end of the trading day is I will go back and I will make a video of myself with my brokerage, and I will look at my charts and I will just explain everything. And the videos are, short. Sometimes, some days the video is only 5 minutes. Other days, if I took a couple trades and things were a little bit crazier, the video can be 15 minutes long. But really, the entire me going over all of my trades and looking at my charts and talking about how I was feeling and what I was thinking and what my trade ideas were, all that, takes up 10 minutes at the end of my day. So I know that I can continue to do that every single day for the rest of my life as long as I'm trading. So you don't want to make your journal so burdensome that you won't sustain the effort. Again, keep it concise, keep it informative, but don't make it too complicated. So depending on what kind of trader you are, your journal can have a few entries a week or multiple entries a day. Obviously, if you're a swing trader or you're a long-term investor, your trading journals you're not going to have an entry every single day. You're going to have entries only when you enter or exit your trades. I mean, you could very well have behavioral or psychological entries where you say, hey, something happened today in the position and I thought about this, or I saw this happening and I did that, or XYZ. But you don't necessarily have to keep a journal every single day. It really just all depends on the frequency of your trading and the frequency of your monitoring of yourself and your interactions with the market. Okay, so if you're an active day trader and can't automate your trade monitoring, you can streamline your journal in a few ways. So these are for, again, people that have super complex trades or don't trade every day. Here's another way to structure your journal. So first off, you can create a single entry for the morning trading and another entry for the afternoon trades. and then your columns would summarize your positions, P&L, and then your associated observations of your trading at those times. So you can say, this is my journal entry for the morning, and this morning I took 5 trades or 3 trades, and this is what those 3 trades kind of look like. And then this is my journal entry for the afternoon. In the afternoon I took these 5 trades or 3 trades, and this is what it looks like. So in other ways, you can create entries for select positions that stand out in your mind because they were successful or failed trades. So you can say, oh, everything today, I took, I'm just going to assume I took 12 trades today, and 2 of them were really, really awesome trades. I did a really good job, and this is the reason why I did really well on those 2 trades. And then one of the trades was just horrendous, and these are the reasons why I did terrible on that trade. And so you can just select the very best and the very worst of your trades, and then monitor yourself that way. And then if you're trading super complex positions, if you're hedging a lot, and the in and out flow of risk exposure, that's kind of a big deal. If you are, if you're never really not in a position, but you're just kind of in and out, and you're moving around a lot, then what you're going to want to do is, at the end of the day, you're going to want to summarize, just with one journal entry, and then you review your major trade ideas, your P&L, and then your self-observations for what you did that day. I added XYZ to my position, I removed XYZ from my position, or I'm thinking of doing XYZ with my position, whatever it is. And that way you keep a monitor of everything that you're thinking, and like I said, everything that you could potentially be interacting with the market. Okay, a big thing, self-monitoring is not one size fits all. The key is to adapt the format to your needs and trading style for yourself as your own trading coach. So you want to be able to accumulate enough entries to notice patterns in your trading. That's really what it is. So that's why I said earlier, if you are just focusing on your best trades or just your worst trades, or you want to journal every single trade, it's up to you. Just as long as you're accumulating, the goal here with your trading journal is just to get as much data on yourself as possible so that you can notice your patterns clearly. So you need enough data to distinguish your best trading factors and your worst trading factors. Okay. And the true value of the journal is that it structures the process of self-awareness and makes it regular and automatic. So the journal will make it a lot easier for you to notice things, because you'll see the more data that you have, the mistakes that you're making, your journal will scream at you, hey, man, you're making these mistakes. You're making this mistake over and over and over again. Or, hey, you're doing this really, really well over and over and over and over again. And this is all your winning trades have this in common, and all your losing trades have that in common. And it just makes it super easy. And you're filling out the journal on a regular basis will give you all that information so you can have it right at hand. Recognize your patterns. So no form of coaching or counseling is set to restructure your personality. If you're ever being coached and the coach or the structure of that counseling is trying to change who you are as a person, you should get out of that as soon as possible, because the goal of coaching isn't to change you, but it's to help you work your weaknesses and build your strengths so that you can express your personality and skills as constructively and successfully as possible. Because when it really comes down to it, you can't change your personality. But if your personality is expressing itself in unhealthy ways, you can curb those unhealthy ways that you're expressing your personality so that they don't hurt you. So how do we begin recognizing our own patterns? Well, it's simple. You review your journal, okay, and then you divide everything into 2 categories. Your best trades, which are your solution patterns, okay, and then your worst trades, which are your problem patterns. Now, a lot of the time, the difference between your solution and your problem patterns, they should hopefully just scream at you what it is that you're doing, right? They will themselves be an action item for you to begin to look at. Okay, so an example of that is maybe during successful trading, you're more patient entering trades, and you trade less, and you reduce the size of your position. So you're not like YOLOing with 1,000 shares or something. Maybe you do better when you're trading smaller, when you're looking over things and you're not jumping into things quite as quickly. And then maybe you realize that on your less successful trades, those are the ones when you are going full size position and you are trying to get as many shares as humanly possible or as many contracts as humanly possible, and that's where you start recognizing those problem patterns. Now, comparisons can also alert you to your coping mechanisms when you're faced with market challenges. So you can see maybe when you're going through and you realize that when you're trading well, you tend to be more problem focused. You tend to be trying to solve that market puzzle and trying to solve everything kind of as an overall issue. And then you realize that maybe when you're less successful, you trade when you're confused or frustrated or upset, and you're jumping in without waiting for clearly defined opportunity. So really, when you're looking at this, even though we divide everything into good and bad trades, what you're looking for are just the patterns, because good and bad will sort themselves out when you analyze the patterns and those problem and the solution areas. And then when you start avoiding the problem areas and engaging the solution areas more, then that good and bad will kind of fall into place. But really, the point of this whole thing is just to isolate that pattern. So strengths will show in patterns and repeat in your successful trades, and then weaknesses will show in patterns that repeat in your unsuccessful trades. That's pretty common sense there. So what if you can't find any patterns? Well, step one is make sure you have enough data. So if you have only been monitoring your trading for a week and you can't find any patterns in your trading yet, well, you gotta monitor over a larger period of time. And another big problem too is that you want to make sure that you are addressing the larger problem. So don't read into specific subtleties into your patterns. So a lot of people, a lot of traders, when they're going into to review their patterns, they get really specific, right? And they say things like, whenever price is within 17 cents of the moving average, we do XYZ. And whenever, this is overlapping, when X is overlapping Y at this exact, don't get too subtle in it, because you want to reduce everything into the easiest, largest pattern. And sometimes your patterns are super obvious and ridiculous, and that's fine, because we all have obvious and ridiculous patterns. And sometimes the mistakes that we make are super simple. Okay, so what you want to do is you want to look over your entries with specific context in mind. Go over all your trading and review things like sizing, your timing, your duration of your trade. Make sure you're going over, how clear you were on the micro picture for the trade, on the minute specifics of your exact trade, your entry price, what you were looking at for your stop loss, things like that, the micro. And then also the clarity of the macro picture. What was the market doing? What was the sector doing? All that kind of thing. Were you aware of the market trend? So just kind of review, go back through and read your journal entries once over for every one of these items, and then just see what you can pull from there. So be aware that you're looking for the basis of what you need to change only. Many times traders fail to make changes because they aren't clear about exactly what they need to change. So this is really important. Make sure you're specific. You want to avoid general phrases like, I need to be more disciplined. Well, okay, you may need to be more disciplined, but how do you take the next step then to be more disciplined? The phrase, I need to be more disciplined, it doesn't give you anything to work off of. If you can say, I need to control my sizing in order to be more disciplined, okay, now you have something that you can begin to work on, and you know that you can pay attention to your sizing in your trades. But if you still aren't sure, if you just have these broader kind of statements for your trading that you want to elaborate on, here are a couple different kind of patterns to go over again. Go look through your trading journal and be aware of these, and see if you can pull patterns out of your trading with using these examples. So you want to go back and look at your emotional patterns. And these are distinct differences in how you feel when you're trading well and when you're trading poorly, particularly before and during trades. So go back and check out your behavioral patterns and see, your emotional patterns, and see how you are feeling when you're trading, and before you're going to get into a trade, when you're in a trade, and when you get out of a trade. Your behavioral patterns, these are notable differences in how you prepare for trades and manage them during your best and worst trading episodes. So how well are you controlling what you're thinking when you're jumping in and out of trades. Cognitive patterns, which are meaningful differences in your thought process and concentration level during and after your best and worst trades. I mean, pretty much it kind of all comes down to, control. How are you controlling your thought process? What's your concentration level like? Are you viewing everything consistently throughout the entire process? Did you do a whole bunch of work at the beginning of the trade, and then once you got into it, you just didn't care and you didn't monitor it correctly? All that types of things. Your physical patterns, differences in how you're feeling when you're trading your best and worst, your energy level, physical tension, relaxation, and posture. This kind of goes into things like, your trading environment and how you're feeling physically. If you didn't sleep and you're, sitting at your desk and you can barely keep your eyes open, that type of thing. Are you more apt to panic and do crazy things when you are not relaxed or when you're stressed out, that type of thing. And then lastly, trading patterns, just differences in the sizing of trades, times of day when you're trading, mode of entering and exiting trading. So this is just kind of the overall specifics of what the actual trading pattern is. So if you're trying to you can obviously pause this video, take a look at all these, and then go back and comb through your trading journal with these different ideas in mind. And hopefully you should start to be able to pull some of these patterns of the things that you're doing well, of the solution patterns, and the things that you're doing not very well, those problem patterns. Establish cost and benefits to patterns. So the first step towards changing is knowing your patterns, right? And knowing your patterns and then having or sustaining the motivation to alter that pattern are two very different things. And we're humans. So motivation is where we all fall short in the process here. This is because, we all have goals, we all have things. It's not that we may not know what we're doing wrong. It's the motivation to actually change it. So your challenge as your own trading coach is to motivate change within yourself. So if keeping a journal is routine and boring, it's not going to inspire motivation, and then you won't be able to sustain that motivation and that effort to change. So staying motivated to make changes can be difficult, especially if you're doing reasonably well as a trader. And this is a big deal because we talk about, if it ain't broke, don't fix it. I'm making money. Things are great. I've made it, right? But that is not when you want to be letting your foot off the gas. That is when you want to begin targeting the patterns of the things you're doing really well, and then start to kind of press down on the gas a little bit and kind of feed those good solution patterns. When you're trading well is precisely the time when you want to be most aware of your strengths so you can maximize your earnings during those times. This cultivates what we call a killer instinct. And what happens is you develop the ability to sense when you have the advantage, and then you press that advantage to your benefit, when you have the wind at your back. So we know that only making modest money when you're doing well is a great way to ensure poor returns when you're not seeing the market that well. So if you're only making okay money when you are at your best, then if you have a bad day, you're going to lose money. So what you ideally want to do is, rather than making good money when you're at your best and then losing money on your bad day, you want to be making great money when you're at your best and then making good money on a bad day. That is kind of where you want to elevate yourself to. And again, that's that cultivating that killer instinct. Because we see when we look back at our patterns that large gains from your best trading periods are what contribute most to overall profitability over time. So how do excellent traders sustain the motivation to operate at elite levels of performance? Well, this is going to sound really simple. It's a little more complicated than this, but motivation is fueled by an intense competitive drive and a ferocious desire to win. So traders with an intense competitive drive are going to compete against their peers, they're going to compete against the markets, and then most importantly, they're going to compete against themselves. They're always going to want to be growing and learning something new and being a better trader today than they were yesterday, because they derive pride and validation not just from making money, but also getting better as traders themselves. So the mindset of the lesser trader, right, is that they trade not to lose money, right? They're not really trading to win and be the best they can be. They're trading to protect their capital. They're trading, just to keep their job. They're trading again to do the bare minimum and then get out. They don't hunger to become more than they are. They're not willing to learn. They're not willing to expand. They're not willing to grow, and they want just to do okay. They want to do well, not be their best. We hear this a lot when people say, "Well, I want to trade, and if I can just trade well enough to make enough money to replace my day job, then that's enough for me." Well, that's not exactly the right attitude, right? You want to be trading to make the best possible trades every single time you step into the market, and you want to just be your best, not necessarily just do well and that's it. Successful traders can sustain their drive by staying mindful of the costs of their negative patterns and the benefits of their positive ones. Now, this is important because staying emotionally connected to the pain created by your worst trade stokes the motivation to avoid trading mistakes. So, we don't necessarily want to dwell on the terrible trade that we took, but we want to be aware. We want to remember that one time that we didn't pay attention to our sizing, or that one time that we didn't wait for that A plus trade to show up, or that one time that we gambled and we fought the tape. We want to remember that cost us, because that's going to lend that emotional connection, so that we remember that you say, oh wait, I got to make sure I'm not fighting the tape. I got to make sure that I'm sizing appropriately. I want to make sure that I'm not guessing, that I'm waiting for those A plus trade setups. So their strengths are not just an abstract awareness of successful trades, but an emotional connection to the pride and sense of accomplishment over doing well. Again, when you say, okay, I'll tell you that sometimes, because not all good trades are green trades, and not all bad trades are red trades, right? But there's a sense of an accomplishment if you take a trade and it's well structured, and you're observing good risk management, and you're observing, good sizing, and you're watching the markets correctly. And if it ends up being red, you still have a sense of accomplishment, because you can say, well, I protected myself in this trade and I did everything I could. So it's that pride when you're focusing on the process. It's the pride in the process. And then the red days, the green days are that much sweeter, but the red days sting a lot less, because you have pride in your process. So you want to make sure you're emotionally connected to what you're journaling about. Obviously, be specific. I mean, no one else is going to read these journals. You're going to be the only person, so you can get as personal as you want, but just make sure that you are remembering things or noting things in a way that when you go back and read them, you can keep that emotional connection to what you did that day or what you did that week in your trade. Because you're only going to want to change your negative patterns when you come to the point of hating those patterns and becoming disgusted with the way they've set you back. Again, this is going from saying things like, oh man, I can't believe that trade went against me, right? Because that's what new traders do. They say, oh, I can't believe the market screwed me, or I can't believe that price action turned over on me. Well, once you get to the point where you are recognizing your patterns and you can see and you know what you're doing, then you start getting disappointed in yourself, right? So it's no longer, I can't believe that I can't believe that Tesla did this and stopped me out. It's, wait a minute, I'm better than that. I had a plan for that. I knew that Tesla could turn around and stop me out that way. So the fact that this happened, was a fault in something that I did, and I really hate that. Like, I'm better than that. I'm a better trader than that, and I know that the way things are structured, I should not allow that to happen to me. So those are the kinds of emotions that you want to be viewing or remembering, so that way you have motivation to change those negative patterns. And you'll want to build on your positive patterns when you see and feel their benefits. Again, when you go through and you create a trading hypothesis and then you place a trade and it does exactly what you thought it was going to do in the exact way that you thought it was going to do, and none of your contingencies were hit, and then you have a big green trade, I mean, there's nothing like the pride of knowing that you made money in the market, and you made money your way, and you made money the right way, right? So when you're coaching yourself well, journaling is an emotional exercise, not just a cognitive one. So again, you want to make sure that you are, jotting down everything, what you're feeling, what you're thinking, and you're the only person that's going to be reading these. So make sure that you are um, keeping all your or jotting down all your emotions and everything that is connected to these trades. You are most likely to change a negative thought or behavior pattern when you associate it with concrete costs and consequences. It's that specificity, right? You want to know that when I don't do this, when I don't observe this XYZ, I lose XYZ. And you're most likely to motivate a positive behavior by attaching a specific felt benefit. Again, when I observe good risk management, when I observe good entries and good exits, that is when I make good money and I feel good and the trade is good and everything's great. Set effective goals. So remember that successful coaching is going to require focus. And because we're human, right, sometimes as traders we can lose focus in our efforts from time to time. A lot of this occurs because sometimes we tend to jump around in our trading or in our journaling efforts. So for example, Monday you're focusing on sizing, Tuesday you're focusing on emotional control, Wednesday you're freaking out about losses, and then come Thursday you're kind of burned out and tired just because you've been trying to do too much throughout the week with your journal focus. So you got to remember that change is gonna require prolonged focus, right? Because you're gonna want to focus on an idea or a goal and then view that over a period of time. So the way you can shorten the learning curve here is by being a little more intentional in the way that you pursue things. So one way is to organize your trials over a concentrated period with immediate feedback throughout. So even if it's something, even if you're working towards, a goal, like let's say sizing, right? And there's not something huge to do every single day, even incremental or small concentrated efforts over a long period of time over a longer period of time will be better. So if you think of it like learning to play the piano, right? It's better if you practice a little bit every single day than if you try to practice once a month or once every couple of months for a prolonged period of time. You're gonna see more success when you touch on it every single day for a little bit. So how do you establish and sustain a specific direction to guide your growth and development? Well, that's easy. Hence the name of this section, effective goal setting. So what you want to do is remember that motivation provides the energy for self-improvement. So goals supply the aim and then help you channel that energy of motivation so that you can implement those changes. Problem patterns alert you towards what you're doing wrong. So if your problem patterns are letting you know what you're doing wrong, goal setting is the awareness of the new thought patterns, feelings, and actions that are going to replace those problem patterns. Okay. So the goal states what you're going to do and what you're going to do or not going to do in any specific situation or specific instance. So you want to think of goals in a process manner rather than an absolute outcome. And what that means is avoid phrases like my goal is to make $1 million or to be able to trade for a living. Because while those are good overall goals, they're too broad for you to have complete control over what they are. These types of goals don't really tell the trader what they need to do today or tomorrow, but they don't tell the trader what the next step is in order to achieve the goal. So controlling the process of trading and focusing on how you make and implement decisions create daily goals you can have complete control over. So if you say, okay, my broad goal is I want to make $1 million, but the daily goal is I'm going to focus on my sizing. And so that tells you the next step that you can start focusing on. The most effective goals emphasize trading well, not making money. Again, we want to focus on the process, not the outcome. If you focus on the process and you do the process well, then the outcome will naturally follow, or the desired outcome will naturally follow. Effective goals target effective trading practices that break trading down to component skills and then set targets for these one at a time. Again, it's that specificity. It's taking everything down to its absolute base level and then setting small incremental growth from those base levels. So you want to think, what is the difference that I'm going to make in my trading, or what is the difference from what I'm doing now that will make the greatest difference overall in my trading? And then another question you can ask yourself are, what are the one or two ways I can trade more like my best trading and less like my worst trading? So if you've set up those problems and those solution patterns. You say, what are the one or two ways that I can trade more like my solution patterns and less like my problem patterns? The answer to these questions should naturally form some type of daily or weekly process goal. So if there's something that you're trying to do specifically that's solution based, whatever that is when you're trading should give you a general idea or something that you can work on for your daily and your weekly goals. So goals should not be so specific that they apply to a limited set of circumstances, nor should they be so broad that they don't guide concrete actions. Again, don't focus on super minute stuff, but then don't go super macro and have a goal of I want to be a millionaire, because again, that's too large to have effective daily goals. So the idea here is to set goals to work on every day for several weeks in order to cement the positive habit you are trying to adopt. Now again, these goals don't have to be huge. They can be, small things. Just make sure that you're touching on them every day or weekly, so that way you are building that process for yourself. Build on your best, maintain a solution focus. Defining good and bad trading in terms of process allows you to be positive and constructive even during P&L slumps, so even when you're having red days. So to keep yourself solution focused, you want to ask yourself, what did I do well today? And then what about this trade did I do right? Even if it was red, there should still be components of that red trade that you did correctly. Because not all trades are poorly conceived and poorly executed losers. So you want to ask yourself questions or reflect on things like, did you lose less money today than the past several days? If that's the case, what did you do right? Did you have a streak of winning trades in the middle of an overall larger slump of red trades? If that's the case, what distinguished that group of winners from the rest of the losers? You want to focus on the improvements and isolate the specific actions you took to generate those improvements in those green trades or winning trades. So sometimes we can stay solution focused by borrowing ideas from others. So what you can do is you can pick a trader or a mentor that you respect and then ask yourself how you would view, or how that person would view, the trading or a particular trading idea that you are trying to implement or that you are trying to use. And what will happen is over time, you'll adopt those patterns and ways of thinking, but rather than using them the way your mentor or your trader used them, because you're just adopting them into your trade ideas, in your trade hypothesis, then that idea becomes distinctly yours. Sometimes it helps to focus on mistakes you aren't making in your trades. So if you have a streak of green trades and you say, okay, well, in these green trades are green, or these good trades are really good because I'm doing this right. And you go through and you elaborate on everything that you're doing right in your good trades and then compare that to what you think you're doing right in your bad trades. Sometimes that will help distinguish the difference, and you can see what you're missing. These note represent exceptions to the problem patterns. And so if you're making a particular mistake, go back and review times when you weren't making that mistake so you can see what your approach to the market was in those trades, whether or not you're anticipating that problem now, and were you anticipating that problem then when it was happening. And another question you can ask is like, were you avoiding the mistake by following a particular rule or practice? When you discover what you do during your best trades, those patterns are uniquely yours. So essentially, you become your own kind of role model or trading guru, hopefully because you're piecing together ideas from other people, but you're creating your own kind of, for lack of a better way to put it, you're creating your own spin on your trading, right? You discover who you are at your best and can create and change goals that fit your specific needs and approach to the market. This form of learning is more empowering and relevant as it reinforces strengths as you build them. So you're not just copying from somebody, you're literally building your own strategy from the ground up. And then when you validate these ideas that you have, then it's just creating more confidence and empowering you to trade better and to be a better trader. So when assessing the ratio of problem journal entries to solution entries, consider these following questions. What specifically am I doing best in my recent trading? How specifically am I avoiding old trading mistakes when I'm trading well? And how specifically am I trading like my idea of the ideal trader during my best trading? So keep those in mind and make sure you're reviewing those as you're going through your journaling, um, especially if you're having, a streak of wins, because that can sometimes shine a light on what you're missing when you're having a streak of losses. Disrupt old problem patterns. Always try to work your way down to the base of each problem you outline in your journaling. And this is really important because sometimes traders think that they have a bunch of problems when in reality they may only have one or two, and these one or two problems that they have just manifest themselves in different ways. So an example of that is, let's say a trader's having the following issues with their trades. They're missing good trades, they're ignoring stop loss levels, they're sizing their positions too small, and they're cutting their winning trades too quickly. Well, these all seem like four different problems with four different approaches and four different coaching plans to fix them, but in reality, something like anxiety related to negative self-talk could be responsible for all four mistakes. So again, that means that the trader doesn't have a bunch of problems. The trader has one core problem that is affecting many different aspects of their trading process. So sometimes coaching means detecting the pattern within the pattern. And if you can identify the core pattern, other trading difficulties can fall into place in a reasonable or within a reasonable period of time. So if you're making, a bunch of mistakes and they're all the same issue that's just manifesting itself in 4 or 5 different ways, once you establish or once you have singled out that core pattern and you start working on that core pattern, then the other 4 or 5 problems that you're having will resolve themselves within a reasonable period of time from there. So you want to ask yourself, what is the common denominator behind all my different trading mistakes? Because the core pattern will involve a feeling state that recurs for the trader and then disrupts that good decision making for those good trades. So tracing each trading problem back to a cognitive or emotional state, we can identify the events that trigger that state and design effective coaching interventions to tackle those situations and triggers. So again, this is going to be different for every single trader because we all have different issues with our emotional and cognitive states as we're trading. But that way, this will help us set up those kind of rules and those roadblocks for us that we can view that can help us get off the rails when we're triggered in these situations. Often a trader will know what they're doing wrong, but won't know the right thing to do to fix it. So this occurs when the trader hasn't been solution focused. The solution requires 2 coaching steps. Okay, so the first one is to interpret the problem pattern so it doesn't disrupt your trading, and then develop rules and procedures for a possible solution pattern. So the key to disrupting the problem pattern is to alter the state that you're in when those problems first appear. So if you are doing the same thing every day, or you're thinking the same thing every day, and you're continuously making these mistakes, then you need to alter whatever it is that you are, ritualistically doing in order to disrupt those patterns. So be vigilant of the emergence of patterns and recognize the characteristic ways that they appear. And we'll touch on that a little bit here in a second. So here's an example we're going to go through. You realize that your worst trades occur when you focus on your P&L as the trade is unfolding. So when you pay attention to your unrealized P&L when you're in the position. So this leads you to tolerate larger losses in small positions because you feel like it's not hurting you as much because you know how much money you're losing in the moment. This can also lead to taking profit too quickly on a large gain because you're making sure that you're trying to book a sure thing or book a win, right? You realize that if you start booking profits during a gain, you need to refocus your attention. So you say, okay, I'm starting to pull my profit within this position, and because I'm pulling profit, I'm focusing way too much on my unrealized P&L. So what I need to do is I need to take a minute, I need to refocus my attention back on the process so that I stop paying so much attention to the actual profit. So the way you do this is you accomplish this by turning away from the screen briefly, refocusing on a nearby object, or taking a few deep breaths, just kind of breaking that trance-like state. And I mean, we've all been there, right? When your eyes hurt because you're staring at that P&L tick away, right? You're staring at those numbers tick, tick, tick. So For some people, or in the case of this example for this trader, it might just be something as simple as turning away from the screen for a couple seconds and just kind of breaking that kind of trance-like state, so that way you can jump back into the trade and you can focus on the actual process. So when you look back, you find it easier to detach from your P&L and let the trade unfold as planned, right? So there it is, problem solution. So there are many ways to shift your state of mind. So every trader is a little bit different. So this is just kind of a few examples of some things that you can do, or try to do, and can help you change your state of mind. Things like taking a brief pause, walking away from the computer, engaging in a quick activity unrelated to trading, have a conversation with a fellow trader, or have a conversation with someone else in the room, take a quick walk outside, go grab something to eat or drink, jot down a journal entry, just to kind of focus your attention away from the screen for a minute. And if you don't have anybody else, you can always talk through your situation out loud. If you're sitting in a room and you're trading and you're feeling nervous, or you're trying to walk yourself through something, talk out loud. If there's nobody there to hear you, or if the people who can hear you don't mind, nothing wrong with talking out loud to yourself. Basically, what you want to do is just do something different than what you're doing in that moment, in order to break that trance, or that bad pattern, or that bad habit. The new activity should shift your frame of thinking and feeling and enable you to approach your situation differently. So how different would your P&L be if you could eliminate the top 5% of your largest losing trades? Often, this 5% would make a huge difference to a trader's profitability. So if you say, okay, the top 5% of your biggest losers, if you could completely eliminate that, most of us would be green all the time, because our top 5% biggest losers are the ones that are dragging us down. So what you want to do is review those trades and interpret the patterns that accompany those losses. And then you want to identify the emotional state and pathway of thinking that triggers that bad trading. And then after you do this and you recognize this, you can stop yourself, or at the very least, because we know that fixing this isn't going to happen overnight, you can at least avoid something completely disastrous, and you can recognize what's happening to you as it's happening. Build your consistency by becoming rule governed. The major goal of coaching is to turn positive trading behaviors into habits. Okay, so what you don't want to do is you don't want to have to sit and think about what you should do in a situation. It should just be natural. You should just know what to do, and it should just come to you automatically. Now, rules are the bridge between new behavior patterns and then those acquired instilled habits. And we see this in play when we learn to control losses big time, right? At first we exit a trade when the pain of loss becomes too great, right? When you're starting off and you take your first couple trades and you're down and you go, oh, I can't take this anymore, so I just sell. And then eventually we create a rule which gives us that stop loss, and that allows us to exit the trade and then manage that risk properly. So rules are basically checks on our impulses. They keep us doing the right thing even when we're not inclined to act in our own best interest. Now, why do we say that? Because the challenge with trading is that the normal human response to the situations that trading presents is usually never the right one, right? If you want to keep your money, your normal knee-jerk response to what happens in the market is not the right one. So you have to train yourself so that you have the correct responses in the market, so you're not panic selling and panic buying. When we create rules, we put a brake on these normal human tendencies. And the big catch for this is that the rules don't have to be complex. They can be something as simple as only buy if the market is down over X period of time, or never enter a trade unless your risk-reward ratio is 2-to-1 or better. So just simple guidelines and simple rules. Your setup criteria are often just a group of simple rules for getting into a trade, or staying in a trade, or exiting a trade. When the criteria are not established as firm rules and rehearsed as firm rules, there's a tendency to violate the setup. Because we know that your trading rules should be dispassionate, they should be mechanical. Trading rules are not cannot be argued, they are hard lines, right? Most frequently, the inconsistent trader is the one with the loosest set of trading rules. So the trader that's like, oh, well, yeah, I normally just buy when, SPY hits this level and then I sell somewhere around this level. No, you want to make sure that you have, I buy when SPY is at this resistance, this support, this level, whatever it may be. Because if you have a loose set of rules, you are in the moment much more likely to not follow them. Recognize that rules are more than just thoughts that go through your head. A good rule also comes with feelings attached. Like all rules, we establish the rule after either a win or a loss. An awareness of both the consequences of breaking the rule and the benefits of following it. So whenever you write down or rehearse a rule, make sure you're emotionally connected to it, because you got to remember that again, rules are more than a guideline. It should represent a belief and a conviction. I think the position is going to do this, and so the rules around this trading hypothesis protect it from this on this side, this on that side, and you set your rules up to protect your belief or your conviction in what you're trying to accomplish in the market. Remember that rules are not things that should be followed, they are things that must be followed. And you want to make rule following so routine that they make extraordinary performance the norm. Again, this goes back to what we were talking about when you are having a good day, you should be having spectacular gains, and when you're having a bad day, you should be having regular normal gains. And this is what helps you create that routine that makes your extraordinary performance the normal, so that when you have a bad day, you're still not having a terrible day in the market. Relapse and repetition. So, you've done all this work to get yourself emotionally stable and understand your patterns, and understand your habits, and build yourself a trading strategy and follow rules. So, what happens when you relapse out of that? Okay. So in practice, there's a series of stages within the change process. So phase one is that we repeat old habits or old patterns automatically, experience consequences, and try to avoid the consequences as much as possible. Stage two is that the consequences of old patterns accumulate and we develop an awareness of the need to change. And though we may not know how to change and may have ambivalent feelings about that change, but we start to develop that awareness that something needs to happen. Okay. Phase three, we can no longer accept the negative consequences of our old ways and commit ourselves to making changes by trying to act differently. So that's that emotional connection. That's that sustaining that motivation to change and grow and change. So we slide back, phase four is we slide back into old patterns periodically when our change efforts lose momentum, creating oscillated periods of change and relapse. So you do really, really well, and then you think you don't need to study anything anymore, and then you get lazy, you get complacent, and then you kind of start to relapse into these old patterns, which creates this kind of this up and down, after a huge winning streak or something of losses that are kind of peppered in there with your P&L. So then phase five is we engage in new patterns sufficiently often that they become automatic, greatly reducing the relapse into old ways. So again, it's that staying consistently connected into what you're studying, what you're learning, what you're doing, even when you're doing well, so that way you can reinforce those patterns and they become automatic. Old habits and patterns are what come naturally, right? Because chances are you've had these patterns for a lot longer period in your life than you've been trading, unless you've been trading since you were a little kid. But I don't think that's the majority of people. If change habits aren't sustained, the automatic old patterns are going to come in and they're going to fill that void. So if you're not constantly fighting for those change habits, then in the absence of those, your old patterns will take over. But that's the thing about this 5-phase layout, is that it tells us that relapse is part of it. So when you relapse, that reinforces that you need to continuously be engaging those change habits, and that it's actually a healthy thing. Now, obviously, huge long periods of relapse aren't necessarily the healthiest things, but relapsing every now and then and realizing that you need to focus on the change patterns rather than your old habits and your old patterns is a normal part of the process. There will always be a tug of war between your old and new habits when you're learning, because again, your old habits are what are familiar to you. That's your knee-jerk reactions. In every change process, there's an intermediate phase in which old problem patterns coexist with new positive ones. And when that happens, when those two things mix, relapsing is normal because you're still trying to figure out, how to overlap one over the other in order to eliminate the old one. And so this isn't necessarily a sign of failure, it's just that sign of struggle. So you hear people talk about, you see memes and stuff all the time in trading groups about, they say when you're struggling the most, like that's when you have to keep going, because that means that you're getting closer and closer to success. And that's because that's what's happening in that struggle. When your struggle is the hardest, it's because your old patterns and your new patterns are coexisting together and they're fighting with each other. And that is when most traders give up. That is when most of those like barfly traders, that is when we talk about the unmotivated penny stock traders, the get rich quick traders, like that's when they give up, because they don't want to do the work to make sure that that their new habits and their new patterns win and beat out the old habits in that struggle. Now again, relapse is overcome through repetition. Repeated experience with new cognitive, emotional, and behavioral patterns in trading is what cements these habits and frees your mind to focus on the markets. Therefore, it is better to focus on one or two changes and institute those with regularity over a longer period than to try to make a bunch of changes in a short period of time. So pick one or two things and then just be aware of those and then implement those for a long time until they become automatic. However long that takes for you, it's different for everybody, but make sure you implement those changes until they're automatic and then move on to the next thing. Create a safe environment for change. So I've got good news and bad news for you guys. Good news is humans are great at initiating change, but the bad news is that we're terrible at sustaining that change. So you need a positive experience to be motivation for future change, not complacency. Now the problem with experience is that experience takes time. Okay. And you can never completely eliminate the time that it takes to learn through experience, but you can shorten it through deliberate, repeated practice. Now, practice sessions, obviously, they condense the coaching process, and you learn what you're doing right and what you're doing wrong, and you can make conscious efforts to repeat your positive performance and correct faulty performance, and then eventually you reach the point where your efforts become natural and automatic. So practice is valuable because it creates a safe environment for making mistakes. Now, this is all kind of common sense type of stuff, but what does practice look like for a trader? Well, for most of us, a trader's practice environment is paper trading. Now, that follows a couple different things. So, first, you have something like a simple chart review, which sometimes the changes you make to your trading involve decisions regarding how you would enter, exit, or manage your risk. You can review charts and discuss aloud each decision you're making at each juncture when you're paper trading. And the big thing is that this lacks real-time trading realism, but it allows you to try things in a slow, conscious, and reflective manner. So again, you don't have the crushing realism of having actual money in the market, and you can slow things down, and you can kind of think through your entire process and make sure that every action that you're taking when you're learning in the beginning is a conscious effort and something that you are able to look back on and analyze. Simulated trading. You can place orders and track profits and losses over a period of time. You can make decisions in real time with real market data without placing any real capital at risk. Trading in a simulator, you can gain many days worth of experience in a single day. So you can go through and you can go back and you can back test, or you can fast forward through certain areas if the day is done or things like that. And you can test many different days worth of information all at one time or all in one period. You can focus your attention specifically on the most problematic and challenging market occasions. So if you say, okay, I have an idea and my edge only appears in these market conditions, and I know that those market conditions appeared last October, last June, and last February. So you go back and you can look at those specific areas of either incredibly good trading or incredibly bad situations, and you can review it that way. You can concentrate your skill rehearsal in context that most call for your pattern. So again, you can go back through and you can see when your specific trading hypothesis or trading idea presents itself. And the last one is trading with reduced size. So when trading with new criteria, you can see how extended holding times would change your view of that position. Some changes are revolutionary, some require small tweaks as you go. So not necessarily a complete overhaul of your system, but just maybe inserting one rule here, one rule there to protect yourself in one small way or the other. You use this small risk size to make your mistakes, right? So that if you have something that you didn't consider or something that happens out of nowhere, it's not completely wiping, everything out. It's just a small mistake. Once comfortable with this level of risk exposure, then you begin to increase your sizing and your prior levels of risk and then building yourself up. Okay. Learning is best started in very safe environments and only later tackled in risky situations, aka start paper trading and then tackle it in the market with real factors and real capital. If you violate safety and security, you create distractions that interfere with learning, and this is a big thing because a lot of traders like to just they say, well, in order for me to learn how to trade, I have to buy a share of stock and see how things work in the market. You don't, because what's happening is you're creating distractions for yourself in the learning process. You want to make sure that you are studying, then practicing in a safe environment, and then once you are proficient with your study and your practice with a safe environment, then you move into a risky situation. So you use these scenarios to slowly bring your risk tolerance up to normal before moving on to the next idea. And one of the greatest mistakes traders make is finding success with an idea once or twice, and then they immediately move into a larger risk taking. So I'm doing well with 10 shares. I'm doing well with one contract. So I've had a couple green trades with this, so now I'm going to triple that size. And what happens is when you eventually relapse, you inevitably traumatize yourself. So remember what we were talking about the patterns, and there's that point in the change cycle and the change process where you're going to relapse, where your old patterns and your new patterns are going to be fighting with each other. When you eventually do relapse and you weren't prepared to relapse, you've been learning and trading with one contract or with 10 shares, and then you up it, and then you end up relapsing with 5 contracts or 500 shares or whatever it is. When you're not prepared to relapse with that amount, that's when you traumatize yourself. And what happens is you create large drawdowns in your account because you weren't fully prepared for your changes, and the results are going to damage you. They're pretty much going to damage you mentally because they're going to start creating unnecessary fear. So you want to structure the change process to provide frequent successes and no emotionally damaging losses, right? So you can, I mean, a lot of new traders focus, like I said, just on the money, but it's really about making sure that you are comfortable in those successes and that you have no emotionally damaging losses, so that you're not, you don't become a skittish trader when you're finally trading with, real risk in the real markets. This sustains confidence and self-efficacy even as you make mistakes. That's important. Again, you keep that confidence and you keep that self-worth, and you keep that belief in yourself, even when you have a red day or even when you make a mistake. Okay, so this next part is going to be rough to hear for some people, but everyone needs to hear it, especially when they're first starting. Many traders are too eager to trade. They crave the excitement and profits, and they find it difficult to trade in an observation, simulation, and reduced risk modes. Now, this is important. If you want to learn how to trade, you shouldn't be actually buying anything in the market for quite some time. And most traders beginning don't want to do that, right? But what happens is this buying directly in and going full risk short circuits the process of regenerating or of generating repetitions that cement new and positive patterns. And when a trader undergoes losses while making changes, they become self-doubting and pull back from their change efforts. So basically what you're doing is you're cutting into that process and not allowing it to work the way it's supposed to. So instead of generating success and confidence, traders learn to fear change and they learn to fear the markets. And what happens is after we have a period of loss, because we're scared, we want to jump back in and regain the lost capital, right? This is revenge trading 101, right? You have a big drawdown, something reverses on you, so you want to jump in and play it back the other way because you just got burned. And that's not correct at all. The goal is to instill the right trading behavior, not make your money back all at once. Again, it's not about the money, it's about the behavior, it's about the process. If you internalize the right patterns, the results will follow naturally. And the only way to internalize those patterns correctly is to allow that change process to happen and not interfere with it and not create emotional trauma and not link your thought process to things that they shouldn't be linked to. Use imagery to advance the change process. So you do not have to trade to rehearse trading level behavior. All right. A huge advantage of the human brain is the ability to generate experience virtually through the use of imagination. We are lucky in that we have this computational power in between our ears that allows us to generate these experiences without actually having to go through, the losses and the physical actions. By creating realistic situations in our minds and using imagination to summon our desired patterns, we can cement these patterns. Now, this is called the stress inoculation approach. By summoning stressful market scenarios and imagining in detail how we want to respond to these, we inoculate ourselves against those stresses by priming our coping mechanisms. So we know that when this happens, we're going to react this way. And when this happens, we're going to protect ourselves this way. Or when this happens, we're going to become aggressive in this way. And it aligns ourselves up with our coping mechanisms to our stresses, so that way those stresses have less of an effect on us when we are eventually in those high risk scenarios. Our coping is mobilized when we imagine anticipated stressful situations, preparing us for when those situations actually occur in trading. Okay, pretty simple. You're inoculating yourself from the effects of stress. So what you want to do is you want to be making effective use of imagery. And what that means is when you're thinking of your trade or when you're thinking of your hypothesis or whatever, ensure that it's vivid and it invokes feeling. You want it to focus on the emotional aspect. You want to focus on the emotional aspect of any verbal recitation. So if you tell yourself, make sure that you keep your sizing down. You want to make sure that you're connecting that with that time that you sized inappropriately and you got rolled, right? You want to focus on that emotional aspect when you're imagining these things. When imagining a bad trade, summon the feelings of fear and frustration associated with that loss, because summoning that fear and frustration just reinforces your need to follow those trading rules and to follow that process. When imagining a good trading scenario, feel the joy and sense of accomplishment associated with the win, because again, that reinforces those coping mechanisms and those trading rules that you're going to follow that are going to lead to that success. And when you experience the mild version of the trading emotions, you can rehearse best practices, trading plan procedures, and discipline, because you are linking those mechanisms with what's going to be approaching you or what you're being confronted with, but it's not going to paralyze you with emotion. Over time, you build an inoculation to the panic you may feel, and this is the goal. This is the goal that when you see price doing something or when you see your chart doing something, that you're not panicking. This process arouses adaptive situational responses without posing a major threat to your emotions or capital. Again, you're building healthy, good wins and good scenarios where you get to have good, happy wins, but you're not having emotionally detrimental losses. All right, so we're going to go over kind of the facets of effective imagery exercises. This comes with a couple different key factors here. So first is specificity. Avoid abstract wins and losses. When imagining a trade, be specific with price, entry, exit, and market factors. So everything again is about these incredibly specific goals so that you know exactly what you need to be doing and what you need to be viewing and what you need to be working on and what you need to be doing better and enabling. Okay. Dynamism. Paint yourself a word picture to review every aspect of the scenario, not just the trade, but emotions and physical factors as well. It should be as detailed and realistic as possible. So you want to imagine yourself as if you are taking the trade. What are you doing? Are you sitting? Are you standing? How are you feeling? Do you think that your heart would be racing? Are you hyperventilating? Kind of everything around the trade. Elaboration. You want to view the entire situation from beginning to end. Don't just focus on the specific trade, focus on how you would find it, what you would do after it, how you would handle it. So again, it's not just when you're going through and you're reviewing or when you're doing your imagery that you're just viewing from the first candle that you bought to the last candle that you sold. What was happening before that first candle that you bought? What happened after that last candle where you sold? What was the market doing? What was the sector doing? When do you think you would have started noticing this trade beginning to appear? Is there a point when you would have started to lose interest or when you would have started to feel like you could move on from the trade? That type of thing. Variation. Once you've worked through the scenario from start to finish, begin inserting variations of outcomes and processes into the scenario. So you want to ask yourself, what if price hadn't have done what it did? What if it had reversed? What would I have done? What if there was a huge spike in volume and something, changed? What would I have done? What if it ended up going sideways? What would I have done? And then once you work through those variations, you again start to build those coping mechanisms for how things would turn out for you. Consistency. Daily repetition of imagery is key. You must repeat this process over and over until the trades no longer invoke panic emotions. Again, creating those patterns and those habits and just making them automatic for yourself. Imagination for the trader is the equivalent of a practice field for an athlete. It's a place to prepare for performance by creating simulated performance situations. You will be the trader you're capable of being in your imagery work and practice long before you consistently enact those ideals in your daily trading. Now remember, that's really important because you're practicing in this safe space and you're practicing in this, minimized or this risk minimized or this risk eliminated space. And so you are going to have the mindset of the trader, the successful, profitable trader that you want to be long before you actually jump into that incredibly risk-averse, space or real-time market scenario. Most successful trading coaching is a result of a creative and tenacious use of imagery and practice. So again, it's all these things and this repetition that creates not only the good trader, but then the good trader that can coach themselves. All right, so that is the end of this chapter. We're just going to do a couple little recaps here for this steps towards self-improvement. So you got to remember that there are many core processes for self-coaching, and they vary depending on the trader. Everybody's going to be a little different. Everybody's going to have a little bit different approach. Everyone's going to have a little bit different timetable. There is no one-size-fits-all for self-improvement, and all major approaches have some effect in their own way on the person who's going through the process and the person who's using it. So not only do the major modes of helping work equivalently, they also can be applicable to the same base problem triggered by the same reasoning. So you can mix and match these things, these combinations of different approaches to the process, to the change, because they can all usually interlock in some way and they can work towards the same base problem. So that reasoning captures the essence of what creates change and what can fuel our efforts to become our own trading coaches. All right, everybody. So that is the end of part 4 of the Daily Trading Coach. I mean, if you want to read more, this is the book, and you can get it on Amazon. It's definitely a great book to have in the library. It's something that you could go back and you'll read through numerous times. But that, again, was the end of part 4 of the Daily Trading Coach. And I will see everyone again in part 5.